Hi everyone, welcome back to Corporate Decoder, the place where we untangle corporate mumbo jumbo so you don't have to. Today, we're diving into Safe and Green Development Corporation's latest quarterly report. Will it be a housing boom or a house of cards? Let's find out. But before we do, remember to join our Discord for even more insights, links in the description. Safe and Green Development, or SGD, just filed their Form 10Q, which is a quarterly financial snapshot that every public company has to give to the Securities and Exchange Commission. SGD is all about building eco-friendly homes. But the big question is always, are they making money or just spending it? We will focus on what they have been up to, their money situation, and whether things are getting better or worse. Let's get started. A major potential shift is on the horizon. SGD is planning to buy Resource Group, a company that turns green waste into soil and mulch. This suggests a big change from building houses to dealing with dirt, and by the end of the year they are expecting to be solely on the engineered soils business. They are also thinking of selling a lot of their real estate investments and re-evaluating real estate related assets. The main reason for that is because after the acquisition they intend to shift their primary focus on Resource Group's main business, but there's a cloud hanging over everything. The auditors who checked the company's numbers are worried about whether Safe and Green can even stay in business. This going concern warning is a red flag. The company has been losing money since it started and doesn't have a lot of extra cash. They're trying to sell properties to get more money, but it's not a sure thing. That means the company might have some trouble keeping the lights on. Before we dig into numbers, there is one more thing to take note of. They did a reverse stock split. Basically, they took every 20 shares and turned it into one share. This doesn't change the value of the company, but it does make the stock price look higher. All the numbers from before have been adjusted to take that into account. Let's get to the numbers. Starting with the balance sheet, it shows what the company owns, which is assets, and what it owes, which is liabilities. It is basically a health check of their business. At the end of March, the company had about $13.1 million in total assets, but most were not in cash. Let's check a few numbers. Cash was very low at about $17,000 compared to $296,000 at the end of last year. That means they are running very low on cash and may need to borrow more in the future. A big part of their current assets are notes receivable, a little over $5.4 million. These are basically IOUs from people who bought properties. The total assets were at around $13.1 million. Teva now, what do they owe? Total current liabilities, what they owe in the next year, were almost $12 million. That includes $8.7 million in short-term notes payable, which means they are relying a lot on short-term borrowing. Finally, stockholders' equity, which is the value that the shareholders technically own, was about $301,000. Far below the liabilities is overall. The balance sheet paints a picture of a company relying heavily on borrowing with very little cash and a low amount of shareholder equity. Next up is the income statement, which shows how much money they made and how much they spent. In other words, are they profitable or not? For the first 3 months of this year, they took in only $18,000 in sales. That's really not a lot, and spent almost $12,000 on commissions. Compare that to the first 3 months of last year when they made almost $50,000 drop, or a bit over a 60% drop year over year. That's not a great sign. Their operating loss, the money they lost from their main business, was around $1.3 million, a tiny improvement to the $2.5 million from last year, a slightly better net loss than last year of about $2.2 million. That means they are still burning through a lot of cash. Looking at the first 3 months of this year, they used about $552,000 in operating activities, which means they're spending more than they are bringing in. To make up for that, they had to borrow over $1 million. This reliance on borrowing to stay afloat is a bit concerning. The total cash at the end of the period was a very small amount of $17,514 to bring in cash from its operations and depending on borrowing to keep going. Now, what about their investments? They have a few joint ventures, partnerships with other companies to develop properties. A 526 of a nation of Sugar Phase. Basically, they sold their stake in that project. This means they are no longer including Sugarface's numbers directly in their financial statements. This generated a note receivable from the sale of equity investment of $4,500,000 with a deferred gain on sale from the sale of $1,504. It is a major part of Safe and Green's story. They have a lot of it, and it is changing hands often. The big one to keep an eye on is this BCVXCG Dev Corp. The loan was extended. The principal balance of the note went up a bit to $2,200,000. Also worth mentioning is that they have an agreement with Arena Investors LP where they can issue stock EC. This is a way for them to get cash, but it also dilutes the value of existing shares. The company went through an asset acquisition of AI technology known as My Virtual Online Intelligent Assistant by Myvon. This gives a glimpse into the technology they hope to acquire. Finally, let's talk about the equity-based investments. They have holdings in Norman, Berry and Sugar Phase, but it's worth to note that in February there was a forced sale agreement by and between the company and JDI, pursuant to which Cumberland acquired the company's 10% equity interest. There are no current legal matters going on that they are aware of. During the 3 months ended March, the company issued 94,000 shares of common stock for the issuance of $14,586, as well as $83,336, as well as 83,333 shares of common stock from the exercise of pre-funded warrants. On March 5, 2025, the company approved a stock dividend from the treasury shares. So what's happened since the end of March? They closed another part of that Arena investment, and the Leighton loan had a consolidated promissory note agreement. Overall, Safe and Green Development is at a turning point. They're trying to shift from building houses to handling green waste. They have a lot of debt and limited resources for the next few years. From a Warren Buffett style analysis, the red flags are certainly waving. Numbers are what matter most, and numbers here don't paint a very pretty picture. Now, what do I think about all this? This is not financial advice. Please do your own research. Safe and Green has made a bold move to change their main business. While the long-term plan isn't clear, the short-term seems very difficult. A turnaround is possible, but it's going to be a long shot. Keep an eye on how this resource group acquisition plays out, and more importantly, whether Safe and Green can actually start turning a profit. Alright, that's our breakdown of Safe and Green Development's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into the world of corporate filings. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.